All right, and back. Welcome back to the David Carmena show. I uh, I appreciate you guys. I am still in the office. That's right, I'm still in the office, guys, and we have a good show for you guys today. The There's a couple of times in your life where you get a chance to maybe talk to a billionaire. Um, and you're getting the kind of a unvarnished opinion of his unvarnished opinion. The we had an interview that was yesterday that was conducted by Jamie Dimon, the CEO of Chase Bank, and it was probably one of the most honest interviews that covered a wide range of topics that I have ever heard him say. He's always been kind of a person that gave a good interview, straightforward, answered the question, not a whole lot of beating around. But this interview that he had with this reporter when he was in Paris yesterday was really surprising. We're going to actually break that interview down and think about what he was trying to tell us directly as well as indirectly. But before we do that, I always got to salute my number one man, my number one supporter, Christopher Williams. Salute, brother. Thank you for coming by. Salute. We got a good one tonight. We're going to look at the tea leaves, and we're going to see what Jamie Dimon said that we should be concerned about in today's market. So salute. Thank you for coming by. I appreciate you, brother. Salute. I appreciate you. Jamie Dimon. Now, a lot of the people that are in the finance space, they may know that name. They may know the brother's name. He's been around a while. He is the CEO of the largest bank in the world. He is the CEO of Chase Bank. Now, we all probably knew that. You all knew that because he's been working for the bank for, 18, almost 19 years now. He's been, in some facet, he's been associated with Chase Bank. But what I did not know until I kind of dived into his background is that dude is worth $1.6 billion. 1.6 billion. That's with a B. I didn't know he was I knew that he was wealthy, but I did not know that he was a billionaire. He's worth $1.6 billion. He gets only 1 million in direct pay. He gets another 33 million in performance pay. So he makes roughly around 34 million a year. But let's face it, guys. If you were $1.6 billion, come on now. What's another 30 something? 33, 34. I'm a billionaire. I'm a billionaire. So he is not, I'm not sure if he's doing it for the money. He can't be doing it for the money. He must be really love the game. He must be really loving the game. Running the largest bank, having these global concerns. In this interview, you're going to hear him say, hey, listen, we move $10 trillion worldwide every day. $10 trillion a day. Somehow, some way, Chase Bank is a part of that transaction. That's awesome. He sat down with this reporter in Paris for almost 20-minute interview. He didn't shy away from any of the questions that were asked. He didn't pay favoritism. He didn't pay favoritism to the right or to the left. He just sat down and answered the questions. And I appreciate that. Let's see what he said. Let's see if we need to be concerned with some of the things that he mentioned directly and indirectly. Let's roll the tape.
You most worried about?
Happy to be here. Well, I think the debt ceiling is potentially catastrophic.
Yeah.
So that's a whole different issue. Hopefully it won't happen. The banking crisis, I still believe, will kind of sort its way through. And it's not anything like '08 or '09. Only a couple of people are offsides with all these various things, which you knew about. So hopefully, it's getting near the tail end of that.
But if you're Janet Yellen right now, what would you do differently?
I don't know. I think we need to finish the bank crisis. I think we've had uncertain policy on mergers, this First Horizon deal. I think we have to assume there'll be a little bit more. So whatever the FDIC, the OCC, the Federal Reserve, whatever they need to do to make it better, they should do. Be thoughtful, be very forward-looking. Not be surprised constantly, because some of these things have been known about for quite a while. And so we've handled three: SVB, Signature, First Republic, and so.
Yeah. So
But
are you asking?
But I think it's very important. The regional banks, who I've been speaking to like every day for the last week, they're quite strong. They're quite worried because of the run on deposits like that. But their financial results are good. Their financial results are going to be good. Okay, next quarter. They're earning money. They got a very good clientele, very diversified, and they're quite strong.
So Jenny, for like a comprehensive solution. So if you're asking Janet Yellen to get the job done, what does that look like?
All right, so this is one of the first things that I want to point out is that when he was naming off these banks, I want you to pay particularly attention to when he kind of stopped himself. He stopped himself. I bet you there's something else. There's another shoe to drop. I'm gonna roll it back just a little bit, and I want you guys to look at how he was about to name another bank or something else, and then he stopped himself. Look at this.
Their financial results are going to be good, because some of these things have been known about for quite a while. And so we've handled three: SVB, Signature, First Republic, and so.
Yeah.
See, you got that? You saw that? Did you guys see that? He was going to say something else, and then he stopped himself. Let's continue on.
But are you asking? But I think it's very important. The regional banks, who I've been speaking to like every day for the last week, they're quite strong. They're quite worried because of the run on deposits like that. But their financial results are good. Their financial results are going to be good. Okay, next quarter. They're earning money. They got a very good clientele, very diversified, and they're quite strong.
So Jenny, for like a comprehensive solution. So if you're asking Janet Yellen to get the job done, what does that look like? That solution.
I'm not asking for a comprehensive solution.
Why not?
Just be prepared for problems. We don't need a comprehensive solution.
What do we need right now? Do we need regulators to look at short sellers of banks?
Yes. Look, my folks would tell me that that's not the problem, the short selling ban. If you actually analyze stocks and short sales, doesn't seem that big a deal. I think they may partially be wrong, because as you know, some people are unscrupulous and they use other means to go short. I think that if you look at the detail, the SEC has the enforcement capability to look at what people are doing by name in options, derivatives, short sales, and they should go. If someone's doing anything wrong, people are in collusion, or people going short and then making a tweet, about a bank, they should go after them, and vigorously, and they should be punished to the full extent the law allows it. So I think it's possible it's taking place. We have no evidence of it, but my experience in life has been don't assume too much.
Do you think that they're looking into it?
I hope so. I don't know.
When you look at some of the position of JP Morgan, of course, you didn't really buy any long-dated bonds. And at the time, a lot of people said, look, stop hoarding cash. Do you think regulators and investors had pushed some of these banks to take unwarranted risk?
Yes, I do. But let's be clear. The people to blame are the bank CEOs and the bank boards and things like that. Having said that, I think there's humility on the part of regulators that the Federal Reserve itself never forecast interest rates going up. Not one Fed governor forecast it. And whether you forecast it or not, you should be stress testing people for it. Their stress tests always had low rates. We always knew about uninsured deposits. And there were huge incentives that banks to put securities in held to maturity, lower capital requirements. Huge incentives to own treasuries, lower capital requirements, and they counted for liquidity. And I'm hoping all that gets looked at, and they should look at it and say, yeah, okay, we were a little bit part of the problem, as opposed to just pointing fingers.
So this is not a regulation problem, it's a supervision problem.
Yeah, it's a little bit of both. They become very related. I mean, supervisors look at, are you doing the right thing by regulations? And like even the stress test, I've always thought that, when you have one stress test and you have a company completely focused on that for 3 months, Does it lull people to a false sense of security that all these other things aren't going to happen? And all these other things in history always happen. And so, I think it was a little bit of a mistake to have one stress test. God, I'm not asking them to do many at this level of detail, but our stress test is 200,000 pages long. Do you think that the last 100,000 pages added value? And my view is it did not.
Do you think but things will change because of this? Is this like a catalyst?
I think it's going to get worse for banks. I think that
What do you
people,
mean by worse?
it's just more regulations and more rules and more requirements. I hope they do it very thoughtfully because, we love the community banks, the regional banks. We're the biggest banks of those folks. But if you overdo certain rules, requirements, regulations, some of these community banks tell me they have, more compliance people than loan officers. And so at one point you make it harder for them to do business. There are already hundreds of rules in place. And in a lot of ways, it's the mix of the rules. If you're going to change liquidity, maybe not capital. If you're going to change capital, maybe not liquidity. If you're going to add TLAC, then maybe you should do something with deposit insurance. They should sit down and have a very thoughtful conversation about what those things are and what we want the outcome to be. And if you look at the present outcome, a lot of things are leaving banks, and they should. I'm not, and if that's what they want, so be it. But that should be done with the forethought. That should not be done because you're just putting rules and regulations in place and you don't know the consequences. The mortgage business, for example, is, largely, not largely, 80% out of banks today. And just be careful about what you wish for.
So you bought First Republic. You've had, I imagine, now a good look at what's inside it. What did you find out?
Yeah, no, we had a good look before we bought it.
Okay, that's reassuring. But anything that you found out?
We had 800 people working around the clock for a long time to look at something like that. And in reality, look, they did some things really well. Like if you talk to their
Another nugget. Another nugget. What did he say? He said that we knew about it a long time. We had a chance to evaluate First Republic Bank. We had a chance to evaluate First Republic Bank. We had 800 people looking at the bank before we bought it. They knew about it. They knew about it. The Fed chair, Yellen's, one of them came around, probably Yellen came around and said, hey, listen, we got a bank in trouble. We have a bank in trouble. We need to bail out this bank. There's maybe something going on systemically. Will you help us? This happened well before it was made public to us. And I guess in a way, maybe it should happen that way. But they knew about it, guys. They knew about it. Absolutely knew about it. He knew enough about it to put 800 people on looking at it to see if it was a potentially good purchase for Chase Bank. So that's another nugget that came out of this interview and how straightforward he was. All right, let's continue on.
I've got emails and great culture, great customers and things like that. Their credit is kind of pristine. That's good. So, of course, we marked all the market and we're all in very good shape. We've hedged all the interest rate exposure together. We've got thousands of people now going out, learning about what their best is. We want the best of both. We're not the kind of company that comes in our way or the highway. And so there's no surprise there. It had to make sense for shareholders, but this notion that it was an unbelievable thing, no, it was a nice thing for shareholders. I have to do that. But we also really did it to assimilate the bank in a way that's very safe for the system, and it didn't cost uninsured depositors, didn't cost the FDIC. It cost the FDIC as little as possible. But I also want to point out, I'd be fine if they want to change the rules a little bit to make it easier for a regional bank to buy a big bank. And the other thing about big banks, which again is, I know, but the thing about big banks, we need healthy big banks. We're the best banking system in the world. And you want that.
Very big.
Yeah, but we're not. Banks are becoming smaller and smaller as a part of the global system. So when they look at banks, they say, oh, it's big. But when you look at the banking system to the system, mortgages have left, a lot of private credits left, certain trading functions have left. A lot of things are going to leave. You have Apple, you have the neobanks, you better be a little more thoughtful about when you say we mean banking per se. And so.
But the U.S., the Americans should not fear too much finance consolidation in your hands.
No, because most of our size accrues to our clients. So if you look at, we do small banks can't do. We do like banking large corporations in 50 countries around the world and move $10 trillion a day. It's hard. So these are big complex things. We're not big and complex we want to be.
Yeah.
We're big and complex because the people we serve are big and complex. We bank countries, the World Bank. We do a lot of things. And yes, we also bank consumers in the United States. But I want the community banks to thrive. I mean, like I said, we want to do everything we can to help them. We didn't want this to happen. We didn't cause it to happen. The second it happened, we knew it was bad for all banks.
But
And
are you too big to fail?
I don't know what that word means anymore. I mean, we're not going to fail, and I don't know what that means. But we certainly didn't mean it to be an advantage. So we've asked all our people when this crisis happened. I don't want anyone soliciting any client or any banker from any bank that's regional bank or community bank, et cetera. So
Is there anything else that you'd be buying? I mean, some of the smaller banks fall.
No,
That's it.
No, I mean, we're gonna have a lot of blowback
We're
on
buying
having
nothing
bought
else.
this one, but it was the right thing to do, But we'll get the blowback. But again, my job is this. People at this thing, they always look at like the financial deal. Forget the financial deal. 800 people working around the clock, 10,000 people deployed now to consolidate systems, risk, fraud, credit, payments, branches, real estate, vendors, technology. It's a lot of work, and it distracts us from those other things. And so, like I said, we did it. It was marginally beneficial for shareholders.
Yeah.
It was good for the system, but and we have to be prepared for the other side of that mountain.
How worried are you about the debt ceiling? So Donald Trump yesterday in a town hall with CNN, A, did not seem too worried, and 2, actually told Republicans to stick to their guns.
Well, it's one more thing he doesn't know very much about. Let me put it in 2 categories. One is actual default. That is potentially catastrophic, and you can go through a million ways, but anyone knows that's potentially catastrophic. And I don't think it's going to happen because it gets catastrophic. And the closer you get to it, you will have panic.
And that's what we talked about here on the show. We've talked about this debt ceiling, and you got it from the number one guy, the number one banker in the world, definitely in the United States, saying how catastrophic this debt ceiling is. I'm going to report later on that they're trying to put a nice little smiley face on it, but they were supposed to meet today. Both parties were supposed to come in, and when they met on that Tuesday, they said that we'll come back. Our staffers will talk to each other. We will come back and meet again today. Guess what, guys? They didn't meet. They did not meet at all today. And they're playing this politics back and forth with this debt ceiling. And the only people that's it's going to hurt everyone, but it's going to hurt us the most. It's going to hurt us the most. So you have the number one banker saying how catastrophic it's going to be if we default. Let's continue on. Very important that we cover that, because it's just that bad.
And so the closer you get, you have markets get volatile. Maybe the stock market go down. The treasury markets will have their own problems. It's amazing. You already have certain T-bills trading at 3% and right next to them 5%. This is not good. And people should remember the American financial system is the foundation to the global economic system. And so, and the closer we get, more panic. We might get downgraded. The last time we were downgraded, we had like 65 or 70% debt to GDP. Now it's 105. Now our deficits are 2 or 3 times that we had back then. So, we better be very careful. And I wish we didn't get there at all. I'm respectful of both sides, who, one side wants to use it to make up for. We got jammed down their throats, and I would love to get rid of the debt ceiling thing, but please negotiate a deal.
Do you think that it'll be at the end of the day the markets that will spur a deal? That we have to get to the point where there's panic.
It's a really bad idea, because panic becomes something that is not good, and it could affect other markets around the world. But yes, at the end of the day, if it gets to that panic point, people have to react. And we've seen that before. And the other thing about markets is always remember, panic is the one thing that scares people. Like they take irrational decisions. I remember even in 2008, people were selling certain securities at 40% of what they would be worth if we had a Great Depression. but they were like, I want out, I want cash, I'm not betting my family's money on this or my company's money. People will panic, and again, we got to be very careful about getting close to a situation that causes that.
Did you get a call from Janet Yellen about this?
I'm not going to talk about personal calls I'm getting. We've all spoken about debt ceiling. I mean, everyone, that's everyone. There's no.
For big banks, are you ready? Actually, how do you prepare for a possible?
We have
default?
a group of people who are very smart, who are looking at, again, it's very unfortunate, it's time consuming, hopefully it won't happen, but it affects contracts, collateral, clearinghouses, clients. It affects clients differently around the world. You have to then anticipate what people are going to do, which is very different than the legality of it. And, and the closer we get, the more those kind of that war room will start. Now it's taking place once a week, but my guess is sometime in, call it May 21st, it'll be every day. And then it'll be 3 times a day. And then it'll be much more conversations with clients about what they need to do to help get them through it and things like that. It's very unfortunate. It should never happen this way.
Fortress Diamond is always about the balance sheet. Should there be a special commission looking at debt in the U.S. that you should run?
Oh, God, no.
Why not?
I don't want to.
On China, they went after tech. They're looking now at finance. What kind of message does it tell companies that want to do business there?
Well, I think you say they're looking at finance. It's been very limited. They've been very much more careful about touching the financial system or outsiders. But look, this is a serious subject. And anything that relates to national security, I'm a patriot first, and I'm going to salute my government. So put that aside. What the government should do and wants to do, and is now saying they are going to do, is have conversations. They're going to be tough, but they should be thoughtful. Certain things are really national security, certain things are not. And we shouldn't confuse the two. America and China have a lot of common interests: climate, nuclear proliferation, anti-terrorism, global stability. And we have differences. We're capitalists; they're not. And it's okay. We could sort it out, but we need to keep the Western alliances together, not just around war and Ukraine, but around strategic, economic relationships, including trade. We can't take trade off the table every time we talk to, Europe or Asia and stuff like that. So I would go back into TPP. I would surround the world. I want to keep the world safe for democracy, and I'd want to have open markets, particularly with Europe. And when I was here last time was when we passed the IRA Act. A lot of great things in that act. But there are things I don't like too much social engineering inside of it, but also it pissed off all of our allies.
But on the China side, so if they start doing more noise on finance, does that hurt Chinese growth?
Probably. I think you've already seen, it's not trade, but you've seen investment going both ways coming down. And that's okay in the short run, but in the long run, we should say and the government's got to decide. This is not going to be business companies decide, nor should they. So when Congress criticizes business sometimes, there may be truth to that. They have to decide what is okay, what's not okay, what do they want, what's security, and that's around trade, that's around investment, that's around sharing IP.
Okay, I give you £1 million, or maybe you take it, your own £1 million. Where do you invest right
Morgan.
now?
I wouldn't buy sovereign debt anywhere.
Why?
I think there's too much. The amount of fiscal stimulus took place and still
Sovereign debt is
the system,
bonds.
QE, these were extraordinary numbers, and not just in the U.S. but in Europe and other parts of the world. Now, when I say extraordinary, I mean extraordinary, and therefore, I think there's a chance you have more inflation than people think. So while the Fed controls short rates, they don't completely control longer rates, and then you could see longer rates ticking up because of higher inflation. And even if there's a mild recession, they continue to tick up. A lot of us experienced that in the 70s and 80s, and I would be a little worried about that. So rates are kind of low, spreads are still kind of low.
Okay, so you're not putting them in sovereign. Where are you putting that $1 million?
Central banks.
For stability. If you look at fragmentation, I mean, the world seems a little bit odd. Like equities are doing one thing, but we keep on being told there's a recession. Why is there this massive idiosyncrasy?
That's the contradiction. There's still consumers in America, unemployment is 3.5%, home prices have gone up for 10 or 15 years, stock prices have gone up for 10 or 15 years. They have $1 trillion more in their checking accounts. They're spending that money. You see it in travel, you see it in restaurants, you see it you've been around here, you see it in hotels, you see it. That's all good, but the excess money is being spent down. So the bite of that is going to happen later this year, early next year, and the bite of QT hasn't happened yet. So if you have higher inflation, so I think it's a
Quantitative
reasonable
tightening.
thing to say those things are coming to fruition maybe sometime in the end of the year.
Yeah.
We don't know the effect of that. If there's I mean, I would take a mild recession happily right now. I am far more concerned about geopolitics, Ukraine, trade, Russia, our relations with China, and et cetera. And I always have to remind all of our public, America has a 75,000 per person GDP. China's at 15. We have all the food, water, and energy we want. They import 10 million barrels of oil a day. I mean, they're not a 10-foot giant and us a 4-foot pygmy. We have to manage ourselves better. I think we can grow more, we can be more thoughtful.
But in the market, so a lot of people say it's commercial real estate. I mean, we talk about nothing else. Everybody knows that could break. Is there something that we're not seeing that could break?
I think it's amazing when you talk about markets that sometimes it's, and the press sometimes, like a bunch of birds flocking to one thing with endless comments about it. Yes, that's an issue. So, if you look at office real estate, in B and C real estate, we'll probably have a problem. Chicago, New York, Portland, Seattle, but probably not Nashville, Tampa, Orlando, Miami, et cetera. So you got to be a little more thoughtful about it. And I think if I remember, banks have $600 billion of office commercial real estate. They had a cushion, so even if it dropped in value, they still have equity in it. Maybe some of that will go bad, particularly if there's a recession. They're going to be okay. It may take a few banks down. That's normal stuff. That isn't abnormal. What is abnormal is the war, trade, the future of democracy. That is abnormal. I'm much more concerned about that
than
than
the markets trade that. Right. If there's a big geopolitics, there's how do the markets do that? Okay.
Look, we're cautious. I remind people, businesses aren't there to trade us sometimes. They're there to serve our clients, okay? And so we're going to serve our clients no matter what happens.
Yeah. James, very quickly, final question. How are you feeling about the Epstein deposition this month?
I am so sad that we had any relation to that man whatsoever. We had top lawyers evaluating this from the SEC enforcement, the DOJ. And obviously, had we known then, we know today, we would have done things differently. But it's very unfortunate, and I have deep respect for these women. That doesn't mean we're liable for the action of an individual, but I do have deep respect for them. My heart goes out to them. And
debt ceiling
All
or
right.
banking turmoil.
So that was his full interview, and he did not mince any words. He went after both parties. He was straightforward. Just some highlights. He said that basically what we was been saying on the channel is that the Fed was more than in part, maybe the driver on some of these bank failures. He said the Fed was the driver on some of these bank failures two ways. One is that all the excess regulation, but then even when they did the stress test, with the to test to make sure the banks were good, then they did artificially low rates. What does that mean? It's like getting a stress test, but not really having real life situations. So you kind of, cooking the system a little bit, especially when you're the Fed and you know that you're going to raise rates. I mean, the Fed is raising rates. The Treasury is doing artificial stress tests on rates that are not realistic or still too low. So having the situation where they didn't test correctly to make sure that the banks were solvent, was strong. The Fed raising the rates, 500 points in, I think they said, in 14 months. And the banks themselves not being regulated correctly, being a little bit too risky, is what caused all of that. Now, what he did say is that, hey, I'm out of it. I'm not. We're buying. Chase is buying no more banks. We're not buying any more banks. So if another bank go down, don't look at us because we're out of it. Having said that, it was kind of a wink and a nod saying that there may be another bank that's gonna, he didn't say it, but sometimes your body language speaks volumes. So yes, he did not say that there is another bank, or he's aware of another bank failure, but I would not be surprised if we don't have another bank failure within 60 days. That wouldn't surprise me one bit. And then he moved on to the debt ceiling. We've been saying here all along that if we default, if the United States defaults, it's going to be bad. It's going to be real bad. You think the inflation has been trending down, but you think that inflation is going to stay that way? We're going to have crazy inflation. We're going to have, in fact, if we default, we have these things that we can count on happening. Government default, we're not paying a lot of people. We're not paying Social Security people who are depending on their Social Security check. They may not get paid. Federal workers, military, they may not get paid. We're not going to meet other obligations. So a lot of people is not going to get paid. It's just going to be a global meltdown, guys. And the Treasury and no one else is going to be able to save us. High interest rates across the board. Our borrowing rates is going to be high because we may get drowned. Our credit most likely will get downgraded, which means that our cost of money will be higher, which means that people that lend the United States money will probably be charging a larger interest rate to do so. But probably most important, the credit worthiness of the United States. We've never defaulted, ever. We've never been a deadbeat nation. They are breaking, or potentially maybe breaking, a tradition that we've had since the inception of the United States. And then lastly, political repercussions. And you know what? Guess what? They probably should be some political repercussions, because both parties are responsible to provide the president with a bill that he can sign and pass and make into law, raising that debt ceiling. And we do, looking at it on the other side, we do have an obligation to figure this out. We do. And so we can't have a runaway budget. We can't every year be hitting that debt ceiling. I think we're at what, 31 trillion now? That's a lot of money. That's a lot of money. So I can see both sides, but both sides need to work together. Both sides needs to work together. And guess what? I'm not so sure if they did that. I'm not so sure if they did that, because they did not make that meeting that they were supposed to make. Now, they try to have a good spin on it and say, hey, the staff people are working on it, and everything's okay. But I don't know. Let's see what they say about this meeting, because they were supposed to meet today and they did not. I'm going to add the spin piece that they covered. And you tell me if it's true or not. Let me go back here. Pull this up. Let you guys take a look at it. And you tell me, are they putting a good face on it, or should we have some concern? Let me add this to the stream. Here we go.
Are postponing a planned White House meeting on the debt ceiling. The president was expected to sit down again with Speaker McCarthy on Friday. Since the two met on Tuesday, staffers for the White House and the Speaker's office have been talking to see if they can find an agreement on how to lift the nation's borrowing limit. Earlier, McCarthy gave his assessment on how things are going.
The staff has met the last 2 days. We think it's productive for the staff to meet again. I have not seen from there a seriousness of the White House that they want to deal. It seems like they want to default more than they want to deal.
For more on this and other doings on Capitol Hill, let's bring in CBS News congressional correspondent Scott MacFarlane. Scott, on Tuesday, President Biden said in these kinds of negotiations, the real progress takes place when the staff starts trading ideas. Does this delay then mean that there's progress or the other thing? And also, if you can you explain that dynamic a little bit about what the president's talking about staff?
Yeah, think of a pastry chef, John. The
I often
leaders
do.
of Congress, well, as one should, the leaders of Congress put the icing and the finishing touches on. They don't do the kneading, the rolling, and the baking. That's often done by the staff. And in the past, we've seen staff level negotiations be the fastest route to iron out intractable differences. And if the staff is talking, that's generally speaking a positive sign. They are baking the pastry. But in this case, in this Congress, there seem to be exceptions to every rule and an unpredictability, which makes not only the future of these talks by staff unpredictable, but it also raises that economic uncertainty that can ding the economy just by getting near the debt ceiling deadline. But one thing, John, I think is generally the rule and likely still the rule. These are closers who are elected to office. Congressional leaders, the president, they close the deal. They finish things. The staff does the legwork in the meantime.
Right. And sometimes floats ideas that maybe their bosses would never admit to in public to see if they can maybe find an agreement. Speaking of admitting things in public, you spoke to members of both parties about the debt ceiling and what it could take to cross the finish line. Let's watch.
Defaulting is not an option. I think the president is making the point that if you want to destroy the American economy and the global economy, that will be on you Republicans to do that.
I'd call on the president to tone down the rhetoric, stop delivering partisan political speeches if we can, and we likely will avoid a default. We must also confront the rate of spending.
And that seemed to be fair. You know, both sides are pointing fingers. And they are saying that, hey, listen, we're not going to default. But, you know, the other party got to do this or the other party got to do that. As long as they start that conversation with, we're not going to default. Okay. Now, all this sausage making and stuff in the back, that is something that has to be done. It really does. And most likely cooler heads being in the room is probably going to help that out. It probably will, because you get these politicians on camera, and a lot of times it's a performance. Their number one job is to get reelected, and they may be performing for the camera. You know, I have my guys back home, my constituents. I got to get reelected, so I'm going to get in front of this camera and perform. But I can send my staff from both parties. They can get together. There's no cameras in the room, and they can try to iron this thing out. So I do think that possibly, there may be some progress made.
Well, the clock's ticking, as you've mentioned several times, Scott. So one of the ways deals can happen is if a member of a party kind of looks like he might shift away from the party. Is anything like that happening? Because those two gentlemen sound like they're pretty much on message.
Yeah, and that's representative of the parties in general, John. We had Congressman Bowman from New York join the growing number of Democrats saying maybe the president just unilaterally does this, tests the law, invokes the 14th Amendment, and unilaterally raises the debt ceiling without Congress doing so. It would be unprecedented, it would be unpredictable, but it would give not only President Biden leverage, but it might help avert some of the damage to the economy.
Yeah, but we don't know what the long-term effect is going to be there. Is going to have to go through the Supreme Court. I don't know if that's a great idea. And then also, the other president is going to have the ability to do that also. And if you can raise it, can you lower it?
Some. Yeah.
Couldn't you artificially lower it? I just don't know. I don't think that's a good idea. How about people doing their job? How about that? How about they do their job? Let's try that first.
Republicans saying, no, you can't do that, first of all, that it's legally questionable, but it might still be a sucker punch to the economy. Add to the mix Senator Sheldon Whitehouse, who chairs the Senate Budget Committee, who has said, let's get the debt ceiling passed and let's do away with the debt ceiling altogether. This bear trap in the bedroom, as he calls it, is waiting for the next president, the next congressional leadership, and can be used by parties to force legislation through that wouldn't otherwise go through.
Sorry, Scott, I'm still trying to handle the bear trap in the bedroom. Let's shift gears here for a moment. George Santos returned to Washington after.
All right, so George Santos is the congressman, the House representative that is in deep water. We're not covering him. We're covering this is a business show, not a political show. And the debt ceiling directly affects our ability to do business. But we're going to end tonight on some good news. We have some good news about the inflation. Inflation overall is going down. And that's the good news that we have. There's been a couple of reports that are showing that inflation is easing. And remember, I told you guys that with inflation, the Fed is looking at it and they want to get inflation down to that 2% goal. They want to get inflation down at 2% goal, and they're looking at all these reports to decide if they can do a couple things, which is they only have three things to do. They can raise interest rates, they can pause interest rates, or they could pivot, and that's when they start lowering the interest rates. So they have really three things that they will looking at doing with the interest rate, and they're looking at these inflation reports that are recently coming in to inform that. So I have some good news about inflation finally, and we're going to cover it, and we're going to see how that works. Here we go. Let me add this stream to. Here we go. I don't want to use that one. Let me use this other one here. It's a little bit more informed. Now, this guy, he's with Yahoo Finance, and they're going to cover some initial things, but I'm not going to play them all because he has some crazy idea of that's not mainstream, that's not normal. It's kind of unique to him. And
well, the word heard around the world.
As
inflation,
analyst,
the latest data around the globe.
He is probably one of the ones that is unique to the general opinion. Let's go ahead and play it, see what he says, and let's see if we can agree with it. Here we go.
Is showing some signs inflation might be slowing, but it's not exactly a clear picture. Now let's let the data speak for itself, and we can start right here at home. The Consumer Price Index, a key inflation gauge, rose 4.9% from a year ago, just a touch lower than March's 5% figure. And the Producer Price Index, which the Fed prefers, rose 2.3% on an annual basis. Now that's below estimates and the slowest annual increase since January of 2021. Meanwhile, in China, consumer prices rose 0.1%. That's the slowest pace in 2 years. Taking a look at the Eurozone, inflation there has dipped from a double-digit peak for the first time in 10 months, allowing the European Central Bank last week to slow the pace of its unprecedented rate of interest rate increases. In the UK, however, inflation remains stubbornly high, sitting above 10%, which caused the Bank of England to hike rates today to the highest level in almost 15 years. But the truth is, we're not even close to where we need to be. Eurozone inflation stands at more than 3 times its target, and UK inflation remains in the double digits. Here at home, we're way above the Federal Reserve's 2% target. So for now, inflation worries will linger. Well, what does the inflation picture mean for the Fed here in the US? The latest report this morning was another sign price rises are starting to slow, if very gradually. April's producer price index rose 2.3% on an annual basis. That's below estimates and the slowest annual increase since January of 2021.
That's good.
Let's break it all down with George Ball, Sanders Morris Harris Chairman. Thank you so much for joining me this morning. So, obviously, trying to make sense of here, searching for some direction. You had the CPI print and today's PPI print, slowing, but perhaps not as fast as the Fed would have liked. How hard, though, will it be, do you think, for the Fed to justify not pausing in June?
Professor Minsky is famous for the Minsky moment, which I think said that if levels get to be too high, there's a catastrophic impact on asset prices. He also said one other very interesting thing, which was the past is instructive, but not predictive. And the data sets that the Fed, that everybody is getting are past and instructive, but they aren't necessarily predictive of the future. With that said, there are some things I think that are predictively quite commonsensical. The Fed's not going to cut rates anytime soon. It's not going to happen. It's a dream. I don't care what the punter's odds are. The Fed is not going to cut rates anytime soon. Their job is not finished. B, if you step back and say, well, you've got inflation running at 2 or 3 times what a norm would be, as you pointed out before, it's still very debilitating to the average man whose wages are diminishing in real terms quite substantially. Thirdly, my prediction: people want.
All right, so his prediction is kind of all over the place. The couple things that he pointed out that most analysts are considering is that, one, the Fed chair, when they're going to pivot. Everyone's talking about this pivoting. When is the Fed chair is going to start reducing interest rates? What we know is that there's an 80% chance that the Fed next cycle will pause. What that means is they're not going to raise the interest rate. They're not going to lower the interest rate. They're going to chill. They're going to chill, and they're going to see how if inflation is still going to be creeping down to their targeted 2% goal. That's what 80% of the market is saying, that there's 80% chance that that's what they're going to do. Okay, if they turn around and do something other than that, then we probably will have some results in the market that is not positive. There'll probably be a lot of turmoil in the market. Now, that's a pause. A pivot is when the prices go down. Now, there's the 80% chance that we're going to pause. That's 2023, 80, 70, somewhere around in there. 2024, that's when the pivot is going to happen. All of these numbers that we've seen this cycle, the CPI, the PPI, all of those numbers are saying that, hey, listen, inflation is gradually lowering, and we're starting getting to that point where we can pause and pivot. So that's the good news that we can end tonight's show on, is that we are starting to turn around. We are starting to see that things are starting to get better, and that's all contingent on we don't have a default. if we have a default, all bets are off. All bets are off. So watch out for the debt talk. We have until the beginning of the month. A lot of people are thinking that Yellen could probably stretch it out to the end of the month, maybe longer. But the closer and closer we get to that default deadline, the worse and worse the market, and we're going to start seeing a lot more things happening negatively. So let's hope that our elected officials get everything together. Let's hope that this weekend, while they are talking, the staff are talking and kind of going through and see what deal they can make that will allow us to, one, not default, and two, both parties get a win. I personally think, guys, is that it's pretty easy. It's pretty easy. They get a clean debt ceiling bill, but then they write something with respect to a clean one, which will, raise it without all these measures in it that would degrade some of the or reduce some of the policies that the Republicans want the Democrats to make. Some of the concessions, roll back a lot of their policy, raise the debt ceiling, but then negotiate, have an agreement that in 90 days or whatever time frame they want to do, that they're going to come back to the table and negotiate an overall bill that will reduce the debt, so that we won't have this situation in a year or 2 or 3 or another 10 years down the road. I think they can do that. I really do. So let's hope that they can. As always, I want to point out that this is for entertainment purposes. I want you guys to like and subscribe. And let's see. Sorry I had to step out. No worries, Chris. We can you can take a look at it. We ended up with some really good news at the end, which is just a quick recap for you, brother. We had Jamie Dimon came on, and he was saying that Chase Bank CEO saying that one, they're not buying any more banks. Two, they think that the banking regional banks and smaller banks are solid, but he was really concerned about the debt ceiling. He was saying that all this interest rates that the Fed is talking about lowering to 2%, if we do not get this debt ceiling crisis under control, all that is thrown out the window. And then I brought on some other people that basically were saying that inflation is going down and the Fed should be in a good position to pivot. So that's where we're leaving, is that the Fed should be in a good position to pivot. Probably we're going to pivot in 2024. We're going to probably pause through 2023. And then 2024, we're going to start lowering the interest rates so that we can get these interest rates down and get back to a more sustainable, palatable interest rate. So as always, I want to thank you guys for coming by. I want you guys to know that this is not I am not your financial advisor. If you make any decision, make sure you consult your team. But you should consider looking at what's going on currently. And to be quite frank with you guys, this is me. I am almost a 20-year real estate professional, engineering degree. I've been in this game. I'm a broker. I've been in this game for a while. And until this debt stuff is taken care of, and because the banks are jittery, everybody's jittery. I'm not making any life decisions unless if there's a deal to come along that is just, a dream deal, and it's kind of everything right. The stars align. You have the money, you have the people, you have all of the resources that are needed to take this wedge deal, make some profit of it. You have your buyer in place. You have your team in place. Okay. But if you're talking about doing a long-term plan where you're rolling out something that you're looking to grow your business over time, or maybe you want to buy this commercial building, unless that commercial building is a sweetheart of a deal, I would probably wait until we get this debt ceiling stuff taken care of. We get this debt ceiling stuff taken care of. The markets start looking, more stable. Maybe the interest rates continue to go down. We don't have a supply and demand issue. Okay, then now is the time. So always consider a couple of things when you're thinking about the purchases. Remember, you make your money in the purchase, not the sale. However, you have to sell to make your money. So always have an exit in mind. You got to have, ultimately, even if you are a buy and hold person, you're going to buy the property and rent it out. Someone has to rent the property. There has to be an exit plan. So always think about your exit plan in mind. Guys, thank you for coming by. And as always, salute and stay grinding. I'll see you guys on Monday. Hopefully there'll be some good debt ceiling talk, and we'll be able to have a little bit more information to inform you on if we're going to crash or hit this debt ceiling or not. Salute. See you on Monday. Stay grinding.